All right, hello and welcome in to another episode of CFP Reacts. I'm so glad that you're here. I am your host, Scott Schiller, board certified financial planner, reacting to the best and worst financial advice you're gonna find on social media. And in today's episode, I'm really excited about this one. This is one I've heard about for a long time. It's called the infinite banking concept. And so the first word there, infinite, really caught my interest. So I'm interested to hear about this one, find out what's the story on infinite banking, how it works, and really the goal here. So let's jump right into it. This was a video from Chris Nagel. He's got 250,000 views and something like 60,000 subscribers. So this is a pretty popular topic, and so thank you for tuning in. Let's learn together. So here we go.
Banking concepts explained. I like to call this BYOB. Be your own bank. So now all of you have an income. And your income comes from one of four different places. You probably got yourself a JOB. Some say that's just over broke. Maybe you got yourself a business and you got income from your business. Maybe you're receiving a pension or some type of retirement.
Very, very few people have pensions.
Or an inheritance. All of that money can come to you in various different durations. It can come monthly, bi-weekly, weekly, as in paychecks. But where does that money go when you get it? Well, the chance...
Your job, your business, there's also passive income. You could have a rental property or something like that. You could also, you mentioned an inheritance. Could be from the sale of a business. There's all kinds of ways that you create income, if you will.
Of your money going anywhere other than someone else's bank are minimal. So if we were trying to take back control of our money, how would we go about controlling our wealth? Because when you get your money, only four different things happen to it. Number one, you save it in someone else's bank. Maybe you put it into a brokerage account. Maybe you
somebody else's bank. That's an interesting way to put it. Okay.
Put
all right.
Into a money market account, but you save money. Number two,
by the way, you could do more with that. So you mentioned a brokerage account or a money market account. A money market account essentially is a cash position. It's a short-term investment for cash purposes. It's liquid. It generates a little bit of interest. You can also have a money market inside of a brokerage account or really any other kind of securities account or investment. You can have a money market in an IRA, Roth IRA. So you're not limited to just those options with what you do with your income.
You actually invest that money through 401ks, stocks, mutual funds, ETFs, Bitcoin, anything that you know, like, and understand that you invest in. Now, we all understand number three, and that is we spend money. We spend money on things like diapers and going out and dinner and Netflix and all those. So your money that came in on the other side, your income, goes out the door in spending. And
it's true about that. That's definitely correct.
Four, one of the most important things we do with our wealth is we give it. We give it to charities. We do charitable giving and all sorts of stuff around that. But what if before you save your money, before you invest your money, you were to just change one thing? What if we moved that money to a place where you completely control everything? Oh yeah.
Oh man, I'm interested to hear about this one. So what, okay, control everything? I feel like I have control of where I'm investing now, so okay.
Is where we want to put your name on the bank. BYOB, or just insert your name right there. Now, let's talk a little bit about your bank. How does it differ than their bank? Well, first, your bank pays you guaranteed interest on all the money you put into it. Number two, your bank pays you dividends each and every single year, because why not?
Because why not? Why not? Interesting. Okay, yeah, why not?
Your bank pays you compounding interest on an uninterrupted basis, meaning you can put money in your bank and then still use that money without interrupting the interest and dividends you earned on the initial deposits. Now, what are some of the pluses to your bank, and why should you consider creating your own private banking system, as I'm showing you? Well, over here, you got 0% market loss. You can't lose money because your
market loss. I'm not in the market, right? And so I think what we're going to find out here is this is for a whole life insurance product, right? And so, you know, anything that says no market loss means also you got to remember that we're not now in the market. By the way, we're saying market, you know, just the pure definition of a market is a group of buyers and sellers. What I believe he's referring to here is the stock market, the S&P 500 United States stock market as an example. And you know, in this account here, we're not invested in the stock market. And so of course, it's not going to have the potential for losses. What it's also not going to have the potential for is long-term market gains as well. So let's remember that. Anytime you see a financial product or an investment product that says there's no market loss, that should tell you that it's not a true pure investment into the stock market to begin with. So, you know, anything, right? So a car, a home, real estate, there's no market loss potential there because you're not in the stock market with an investment like that.
Bank, like I said before, pays you guaranteed interest. That interest and dividends that you earn also grows tax-free if your bank is set up properly. Your bank would allow you to leverage the money in there because it is guaranteed. Therefore, you could leverage this to get loans and lines of credit and all sorts of other things. It could be collaterally assigned.
This is not the only place you can collaterally assign something. And yeah, I'm interested to see where he goes with this. But yeah, loans, I mean, loans and lines of credit don't sound that great.
Money inside your bank is protected from judgments and liens in almost all states. It also provides a legacy. So if you have people that you love, your beneficiaries, your family, yep, your bank provides an instant legacy, and your bank allows you to fully control all of it.
Again, with the fully control, I don't understand that. You know, and in your investment accounts, in your IRA, your Roth IRA, your 401k, any other investments that you have going, I don't understand why you're not controlling that as well. Versus this. If anything, I think the whole life policy, and you know, I think we'll get to it eventually here, it would give us less control anyway. Regarding judgments and liens, retirement accounts, you're going to get the same levels of protections there from creditors, things like that, and so nothing special here.
So let's move into your own private banking system, because doesn't that all make sense? And since
of course it does.
We have created our own banking system and we get all these benefits, well then after the money goes here first, what will happen is now we can go from our banking system back up to the places that money goes to work. And this enables you to control 100% the flow of your money, which I'll show you next. But seeing as though we change...
Again with the control thing. We've heard that how many times in this video so far? Like 10 times? I mean, you know, I don't see the additional controls versus everything else here.
Where the money went first, and we put it into your bank. So this is the first place. And then once it's in your bank, what we want to do is we want to move that money back over to places that you control, where we can save money, invest money, spend money, and give to charities. Like I mentioned before, the goal here is for you to become your own bank. And by changing where your money goes first, you're going to put it into a machine. We're going to call it your bank for now. And then what we're going to do is we're going to make loans from your bank, and then we're going to clear those loans through their bank. Hence, in the middle, segregated account. What we're going to do is we're then going to lend that money over to take advantage of opportunities. What are those opportunities? Well, you can use that money to buy cars, you can use it to buy houses and real estate, you can invest in real estate, you can do private loans.
Yeah, this looks complicated, number one. Number one, it looks complicated, right? Now we've got some sort of segregated account, and we're doing this lending and loans, and we're now buying cars with it. I mean, this is one convoluted mess here. You know, really the idea here is what he's referring to is investing money in paying premiums into a whole life insurance policy, which will then build up over the long term cash value through dividends and interest, and then taking a loan out of that policy, okay? And so in a whole life policy, we get tax deferred growth. What tax deferred means is that every year that the gains involved are not showing up on your 1099 or on your personal tax return. And so that allows more of the money to stay in, and we can compound money faster. It's why in your 401k or in your retirement accounts, you receive tax deferred growth. The returns that we see are not taxed. When we go to take a withdrawal or a loan out of the policy, then it is not taxed as well. And so that's how it becomes tax free. But if you're using that money to buy a car, I really don't think you're not getting ahead. You might as well just spend it from the very beginning, right? So you mentioned earlier, taking your income and changing where it goes, might as well just went and bought the car outright and avoided using a policy like this to do it.
You can pay down debt. You can invest that money in things you know, like, and understand, like stocks and ETFs and Bitcoin. All these opportunities are going to earn you.
If you know, like, and understand those things, why not just use those?
Some type of interest, rent, and gains. We'll call that profit, but hold on.
That's not profit.
When we make that interest, rent, gains, profits, what that money is going to do is it's not going to go back into their bank. We want that money to go back into our bank. So as you can see, we're going to draw a little arrow going back up to your bank. So the money starts in your bank, goes over to take advantage of opportunities, and then when the opportunities earn you interest, gain.
How are you going to get interest off buying a car? If anything, you're going to pay interest. Maybe if you reinvest it into something and earn interest, yes, but not if you're going to buy a car or give it to a charity.
Rent, whatever it is, that money goes back into your bank. You fully control the entire process. But the most important thing is, when you take the money out of your bank, you are going to take it as a loan. Why? Well, because you would take a loan from anyone else's bank for most of these things like cars and trucks and real estate. So why wouldn't you take a loan from your bank? By taking a loan from your bank, your money...
You're not taking a loan. You're not taking a loan from your bank here. When you take a loan from a whole life insurance policy, there's interest that you need to pay on that loan. That is then going to be deducted from your death benefit value. And so in a policy, you're the owner as an example, and what's called the insured. And so the insured is the person that when they pass away or they die, the death benefit is going to pay out based on that person's death to whoever we name as beneficiaries, which would be the same as if we were doing any other type of investment account. But you don't have a bank involved here that's yours. It's just really just a fantasy.
Stops earning compound interest. It literally earns uninterrupted compounding interest, and that is the sweet spot. And as you do this, as you become the bank, you make the spread, not their bank. Now, in the middle, you will see segregated account. That is a separate bank account. The only reason we use a separate bank account from someone else's bank is because of books and records. We want to clear our bank's money through their bank, so we have records of that money leaving us.
So in order to be my own bank, I need to use someone else's bank. It goes through that other bank and then comes back to my bank and then goes back to their bank and then somehow becomes my bank, and then now it's okay.
Bank and then coming back into our bank. Don't overcomplicate that. So how
that sounds really complicated.
does all of this work? Well, it works just like a bank does. So let me explain. All of you know how a traditional bank works. It's simple. You make money. You take the money you earn by trading hours for dollars or any of the various other ways you can make money, and you put it into their bank. Now you can see in the middle I crossed off their bank, but it's okay. You definitely put it into someone else's bank. And what do they do with it? Well, first off, they pay you interest on the money, right? They pay you some form of interest on the deposits you make in their bank. But then they immediately take your money, your deposit, and they lend that money out. They lend that
This is true.
money out to people to buy a house in the form of a mortgage. And when there's a mortgage issued and the bank issues that check goes to the seller of the house. The seller of the house takes the money from the house they just sold and they put it back in the bank like they've always been taught. The bank takes that money, that deposit, and lends it back out to someone that wants to buy a car or a truck. And that car or truck is in the form of a car loan, and they put a lien on the truck, just like they put a lien on the house in the form of a mortgage. The car dealer or whoever sold the car gets the money and does what they've been taught, puts it right back in the bank. Then the bank immediately turns that money around and lends that money back out to someone doing a remodel on their house, maybe an addition, a bathroom, a kitchen.
These are all traditional banking functions, the business of being a bank and taking care of things. And there's risk to banking, right? Banks fail all the time. Why? Because, there's risk to it. You're giving out loans. Sometimes people don't pay back those loans. Well, how do you get the money back? Well, sometimes you got to go through legally, and there's costs and there's losses. And so it's not exactly an easy business. And so there's a reason why that financial services includes banking, because it's a tricky business. It's a business that needs to be operated and run. It's not something that you can just personally do on a whim and go, you know what, I'm just going to become a bank. There's a lot that goes into it.
That money from that remodel goes to the contractors. The contractors do what they've always been told and put the money right back in the bank. The bank immediately lends that money out to someone that just got themselves in a little bit of debt. And that debt is called a debt consolidation loan. That pays the credit cards off, and the credit cards take the money and put it right back into, yes, you guessed it, the bank. And let's look at who controlled every one of those transactions in the traditional banking system. Was it you? Because it's your money, right? It was your hard-earned money that you trade hours for dollars for. No, it was the bank. The bank was in full control. And how much risk did the bank actually take lending your money out? Well, the answer is not much.
No, that's not true. They take risk. Like I mentioned earlier, banks fail all the time, almost every single day. Some bank will fail. It's normal. It's a part of the market cycle, and there is risk.
All of these loans, except for the debt consolidation loan, were all collateralized by real estate, a car, a second position on the real estate for the remodeling loan. And the debt consolidation loan was the one with the highest interest. Why? Because it involved the most amount of risk. So each time the bank lent your money out and our money out, they made a spread because they paid you interest on the money at a lower rate than what they charged you on that money. The bank makes your money work for them, and they make a spread. The difference between the interest they pay you and the interest they charge you for the loans you take. Now, in that example I just did, the traditional bank is in control. But if you are the bank...
Is it in control, though? Because can't you just take your deposit out if you want it, right? I feel like even as the owner of the bank account, you put the money into any kind of bank. I don't understand why there's a loss of control there.
Then you are in control and you make the spread. Hence, be your own bank. So, what is this machine that we're going to put on money?
By the way, an investment product or an investment concept that is being referred to as a machine is a big red flag right away.
And, that one change that you mentioned? Well, let me explain. That machine is nothing more than a specially designed and engineered whole life insurance policy from a mutually owned insurance company that pays dividends. Yeah, I know what you're saying. You're like...
You can't engineer a whole life insurance policy. That's just the terminology and phrasing. It's just not possible to engineer a whole life policy.
Say what? I'm not putting my money in one of those whole life policies. All the gurus say that that's the worst place I can put money. However...
That's wrong. If a guru says that's the worst place to put money, that's not correct either. A whole life insurance policy is designed for cash value protection with the death benefit protection, right? So cash value is a balance that you maintain in the policy as you're paying premiums over the long term. And we talk about long term. We're talking 20, 30 years, right? So I own whole life insurance policies personally. And, the first few years of paying premiums, most of your premium that we're paying in is going to go to, number one, the agent commission. So there's a commission paid to the agent. I did a whole separate video on how financial advisors get paid and a detailed description of commissions and what they are. But it goes to the commission for the agent and then what's also called the cost of insurance, right? So the life insurance company, there's an expense to cover you, right? So if you were to pass away the very next day after a policy is issued, and you have a $100,000 face value or death benefit, well, your beneficiaries are going to get $100,000 tax-free. And so there's a cost that the insurance company needs to charge each of its policy owners to make that possible, make that happen. And so, you know, it's the type of product that has its fit. Is it wrong to say, you know, nobody should ever use a whole life? Yes. The idea is to keep an open mind, and there are good fits for whole life policies. It's certainly not to create and try to, you know, make this you know, crazy wizard stuff, and so that you're now your own bank.
Let me explain to you why what you've heard about whole life may not be the whole truth. So like I said, you're going to change one thing, and that's where your money goes first. And your money is going to go into this specially designed and engineered whole life. But the whole life is designed and engineered different than a regular whole life policy. Because remember, we're not looking to buy life insurance. What we're looking to do is set up our own.
We're not looking to buy life insurance, but we're going to buy or pay premiums into a life insurance policy. Okay, should we end the video right there?
Private banking system, right? Absolutely. So the first thing we got to understand is the money we're going to put into this specially designed whole life is going to be premium deposits. So we got to change our mindset.
There's no such thing as a premium deposit. When you make payments into a whole life policy, it's a contract. It's a contract between you as the owner and the insurance company itself, and you are paying a premium to maintain the contract itself. And so there's no such thing. A premium deposit is a made-up word.
Because when you put money in a bank, you make a deposit. So when we put money in our bank, that whole life policy, we are going to make premium deposits into the whole life contract. Now remember, I said it's a mutually owned life insurance company that pays dividends. That's very important. What you're doing is you are capitalizing the policy and creating your own banking system. Now, one thing that's very important to understand is when we do this, like I said, it's being designed and engineered. So that means that we're not going to just put the money in the regular base part of the whole life. We're going to put a majority of the money, a high percentage, into this separate pot of money held by the insurance company, and they call it PUA. Yes, PU, but that doesn't mean it stinks. That means paid up additions. Now from this
okay, paid up additions is a part of a whole life policy where you are using some of the portion of your dividend that you receive to buy additional units of insurance. So it's increasing your death benefit as your cash value goes up. There's absolutely nothing special or engineered about having your dividend option be paid up additions. That's very, very common.
Of money. This is where we're going to take loans. When we need money, we can take money because this is our bank.
You can take money only if your cash value's been built up, and that takes time. That takes years. Okay.
Banking system, not theirs. There's no applications, nothing like that. Answer 3 or 4 questions on who's taking it. You don't need to tell them why you're taking the money, but you just need to tell them where it's going to go. You see, you own it, not the stockholders.
That is true. It is easy to take a loan. Part of the reason why is what he's not telling us so far is that there's interest owed on that loan.
Traditional bank, usually they're owned by stockholders, so they got lots of rules. But this policy, you own it. It's your contract. It's your banking system. You are the policy owner, which means you fully control it. Which also means when you want access to your money, all you need to do is take a loan from your policy. Now, when you take a loan, it's very important that you understand what taking a loan is. So now when you take a loan, you're actually going to take a loan from the insurance company's general account. But what the insurance company is going to actually do is they're going to give you some of your death benefit while you're living. That's right. We no longer need to wait for this guy, the Grim Reaper, to come and take you so that you can have the money going to your beneficiaries. No. What this is going to do is we're going to basically bypass this little bugger here. We don't need to wait for the Grim Reaper to get our money because the insurance company will let us use our money early before we die, and all they're going to do is they're going to take that money from the general account and give it to us to use to do all the things we want to do with it, like those opportunities we spoke about. Now, when you take money from...
I still don't understand how this is different from just having your money in a bank account, earning interest on it, and then, you know, just, I guess, taking the loan out. But, you know, the loan isn't going to help you. It's not going to be a road to long-term wealth or anything like that. And the death benefit was never going to be for you. It was always going to be for your beneficiaries.
Death benefit. That money will be collateralized. That loan will be collateralized by the money you have in your policy. That paid up additions and also that premium deposit into the whole life contract. That money, your cash value, will collateralize the loan they give you from your death benefit. Now, the nice thing is, when you take a loan from the policy, that loan technically never needs to be paid back because essentially they just subtracted it from your death benefit that has to be paid out the day you die. So there you have it. I, B, C, explained. Hopefully.
So there you have it. It's that simple. That did not sound simple at all. That sounded like a very, very complex explanation for something that really is not something that's going to work. Okay, again, the concept of a whole life policy is to, in the end, when we look at a 20 or 30 year time frame, our return on our investment, or our ROI, is going to be, we can expect that to be somewhere around 3 to 5%, somewhere right in there. Okay, it's designed to be a safe, long-term investment that's not tied to the stock market, that also provides us a guaranteed death benefit when we die to our beneficiaries. That is what whole life is designed to do. And you say whole life, what does that really mean? It means that when you first open the policy, you go through what's called the underwriting process, right? And so the insurance company is going to want to look at all your medical stuff to see where you currently stand from a health standpoint, to determine your what's called rating, right? And so if you're super healthy, you'll get what's called an ultra preferred rating, as an example. And that rating will determine, you know, what your premium will be owed and what type of death benefit that they can provide you and things like that. But the idea is once you're cleared through underwriting and you receive your rating, it cannot change, right? So if you end up getting sick or your health declines after that, you have it for life. The insurance company can't then come in and later and say, you know, oh, well, now you're sick, we don't cover you anymore, unless there was fraud involved, something like that, right? And that is what a whole life policy is for. I've said this in other videos, you know, the idea behind these financial products or investment products is the best way to use them is use them the way they were designed to be used. Once we start trying to make them something else, like a bank or a place where we want to intentionally put premiums in, which by the way is gonna take time to grow, and you might be thinking, well, there's also, what about a single premium, right? What about a single premium whole life, right? Which means I can put you know, a bunch of money in right away and you know, immediately, number one, you're going to pay agent commissions and cost of insurance right away. But you could also create what's called a modified endowment contract, or an MEC, or commonly in our industry is referred to as a MEC policy. And that if the policy is now a modified endowment contract, it loses its tax status. It's now a taxable account. And so it defeats the entire purpose, right? So most single premium policies I've seen are not you know, eligible for this. Would then be taxable. So it would be modified endowment contracts. And so again, you know, work with a good planner. You know, that's where a good certified financial planner can help you. You know, avoid these kinds of things. If it's too good to be true, it probably is. It almost certainly is when it comes to investments and investment products. You know, this be your own bank concept is one of those. I just cannot imagine having success with this. Not something that I would recommend or do. Certainly something to discuss and debate. So please go ahead and like and subscribe to my channel. And in the comments below, let me know what you think of this video. Let me know what you think of the infinite banking concept. And also, please let me know of any other videos or topics or anything else you'd like me to react to, and I will do my best to get it done. And thank you so much for tuning in, and I'll see you in the next video.